Okay, so you've got your dealer table over here. And essentially what it's trying to do is take all of the stuff that you see here, where you've got like various trends, and kind of boil that down into something more simple to understand. So, all right, let's take a look at this, right? You have various sectors listed here, like all of our own sectors, so not just the stuff that is all automatically already grouped for in the market, but we like take the most liquid options and then we like group up ourselves. And I'm only repeating this for people who may look at this on YouTube later. And then what we do is we break them down by various time frames. So you've got 1 day, 5 day, 10 day, 30 day, 60 day, right? And then the sigma changes alongside that. Now, to identify like whether or not something is going to continue in trend, typically like what we'll do is like I'll look at this and let's just take consumer software, prepackaged software. This would be like Adobe, CRM, stuff like that. I'll look at this and I'll just see, okay, in the prior periods, like the 60-day sigma return, my bad, should go back to this one. All right, yeah. So in the 60-day sigma returns here, you've got like a minus 0.25. There was a 50% increase overall over the last 60 days. The sigma change here is minus 0.39 over 30 days, and it's minus 108%, minus 115% on the 10-day, another negative sigma. On the 5-day, you've got an increase of 8%, slightly positive sigma, and then on the 1 day, you've got a 1.3 sigma, right? Now moving away from consumer software, and we're on Asia consumer discretionary instead. Now, when I look at this, like visually speaking, you can kind of see exactly what it is showing, right? So if you go back 60 days, you can see that there is like a minor increase on a percentage basis, but then when you look at 30 days, so on, like it's just a continued kind of trajectory down, right? The key thing for this is looking at when you've got negative positioning over here as an example, but then it starts moving into a positive, that's when you know there is like accumulation, and as a result, you're going to get a move up. So I'll take examples that we've got in the past, like big tech as an example. That's had like negative sigma changes. So like these moves up aren't that great in comparison to like what it's seen in the past. There is, or there are rather, increases as well on the percentage change side, which is also very important. And I look at those too. But what you can see quite clearly is major increase over the 60-day period, decent size increase over the 30-day period, 10-day period, you got another increase, major increase over the 5-day, and then right here it's like really like whittled down. But there's nothing negative here. So whilst we were like dumping in big tech, like briefly for small periods of time, nothing really happened. It was unchanged, right? Because you had extremely strong accumulation over time, which is basically signaling that they're going to keep buying. I think there's a good example of this with, I want to look at Amazon. So if I like whittle it down and start looking at an individual ticker, like you can see Amazon over here on the ticker dealer view. So these like complement each other, as does this table. And one thing that's like really obvious is if we look at price trend, right? Amazon over the last like 60 days or so, so if we go back to sort of like the second, Amazon started whittling down, pushing all the way lower. The positioning was following it right up until around here. Now, Amazon kept going lower. It was at 101, went all the way down to 91, and then from there as an inflection point and just boosted the entire way again. During that period, though, if you look at the change in positioning, and this is like just taking an individual example because you're not necessarily just going to be taking a single sector. If we look at the same thing on big tech, so that date here when it started to increase in terms of its positioning was around 21st of Feb, right? Go on to big tech as a sector. It doesn't go back the entire way because only looking back 30-day period, but you can see that there is a pull down coming from big tech overall up until like earnings, and then that's where it started to like boost up pretty much. In fact, about a week to 2 weeks prior, it already started picking up a bit more. Like it was going down, but then push up, going down and push up. Amazon did the same thing, except on here it's like more obvious that there is accumulation, and it's happening prior to its move up. So you have these extremes that appear. So you look to reverse the extremes because same way with like anything, um, with price generally being like a mean reverting process, unless you've got major news that's going to cause it to change its general course of action. But from a quant's perspective, we assume a lot of things, and one of those things are that price will mean revert because markets are generally efficient, and as a result, we can like take advantage of that and really like look to benefit from processes where markets, as usual, go through cycles of euphoria and dysphoria. And that's what we're looking to do here. So this positioning is increasing, price is going down. I'm looking at this and I'm thinking, well, I don't really want to continue to be short. And if I am short, I want to start taking profit because really this is going to reverse. Now, the major low was on the 21st of Feb. The actual low on price was about 3 weeks later. And then from there, it really started to pick up. You did get continued pushes down, but namely on like the 7th of March. And after that, it continued, right? And then from there, you just see like continued trend up. Now, it's not been like a simple road. Like you can see quite clearly, there's been just continuous sort of ebbs and flows that people have started to come out of that. So that's just like one example of like how to follow a trend. Like when you're looking at these time frames, if you're seeing negatives, but then you start to see positives, that'd be a point where you start to like look for a reversal. But to look for a really good, strong reversal, what you want to see is an extreme, right? So typically, like you'll get a blow off top in positioning. An example would be here for blow off top. So here I'd be looking for like, okay, ideally I really want getting short, and if it's not short, it's not necessarily going to go down straight away because of momentum and so on. It will eventually, especially if this trend starts to continue. However, a lot of this is probably like due to vol crush and so on, given ER. So not an amazing example. But if we look at other examples, like back to December, here you got a blow off bottom, as it were, and around this period here, on the 14th of December, this essentially once again marked the low within 2 weeks, and it's the same pattern as you saw over here, right? You have like the major low, never really went down to it again during this entire period, kept going up. 2 weeks later, it's going the other way. Same thing again here. Major low, continued momentum lower, and then all of a sudden really picks up and goes the other way. Now, how is that visualized on this table? Like if I'm looking for an individual sector, what I'd look for is like a major sigma event. So I'm talking 3s, 4s, 2s at least. And if you get them across the board on every single time frame, then it's more likely to reverse, because now it's saying essentially without you having to look at a chart visually, you've just got the numbers, and the numbers will give you that answer before you even need to go and visually inspect anything. We'll bring another example. I think Microsoft was one that rings a bell. So here is another one. Same thing again, except this was much more reactive. And I think, I mean, also at the same time with Microsoft, what you had over here was like price started picking up at 219, 220-ish. You had a big push down in positioning down to the 7th of November. At this point, it already started picking up. But and I think there's also around like ER as well. Once you get this like major low, you can look for a general reversal. And pretty much, I mean, since that point, yeah, it's had like a sort of mean reversing process. Like, I mean, it went up to 260 and then back down again. But after that, like, you've not seen anything else. There's not been another meaningful low. It's just continued its uptrend. And now you're getting to the point again where it's like sort of getting super extended. We've not seen over the last sort of 6 months here positioning like this in Microsoft. Now, do you get momentum? Sure, but when everyone is already crowded into the same trade, that's not when you want to be in. It's usually like when you want to start getting out. And I mean, visually here, you can kind of already tell whoever was trying to play this trade here has already started, and they started around here, here, and here. Does that make sense? So TLDR, because I've gone through a couple of things. You look for extremes across every single time frame, whether it's positive or negative. So twos and above, or -2 and below. The larger, the better. That's what you're really looking for.
Um, Quick thing. Do you maybe want to hit on like the that 5 day change rate that you just had up where it was like negative, yeah, like 10,000%?
Yeah. So like,
How would you interpret that?
yeah, I mean, like it's going to be visible here.
Right.
So the,
But so then do you look at that then as like a reversion? Like are you looking to long?
yeah, so I'm looking at this and I'm thinking, I want to be at a point now where, I mean, I can look at this on every single time frame. It's basically negative. All the percentage changes are negative. Seems like at this point, most people are or were short, and based on that, I would start to like look to take the opposite side of this trade. I don't want to be short here unless there is a reason to be short. But if you're playing it over a shorter time period, you've got the opportunity to get a reversion just out of the fact that positioning will change. People will roll out of some of their shorts because they've been successful in it. I mean, our renewables index is down from 150 to 120, right? That's a 20% decline, um, which is pretty big. So you've got the opportunity to like take a reversal trade on that, and those would be names like EMPH and First Solar, those kind of names.
And do you know what kind of setup on a Sigma table it would look like? Something that would keep going in the same direction. Do you have an example of that?
Uh, I don't have any to hand per se, but I'll give it a hypothetical example, right? So energy was an example here. Um, we were talking about energy last week, and I was saying like energy is a trade that I think can start to turn around. Um, um, I think we were looking at. Yeah, okay, so I'll put up one of the tickers, and these popped up also not just on here, but on the Pluto alerts and so on, right? Looking here, you see basically what we were kind of like looking at last week. So, I mean, this is the 28th. We go to like 21st. So, energy's been like pretty much in, I mean, if you're a technical guy, you're looking at this and thinking cup and handle. uh, I'm not, but if you're looking at positioning, positioning's fairly flat. It's drawing down though, and we're still moving up. But positioning isn't hyperextended. It's not hyperextended how it was over here. Like here's an example of like where I wouldn't want to be long. This was a blow off top, and pretty much from there it just like rejected, right? And you can see it in the positioning. Now, with energy, if I look at the Sigma tables on the 1 day, like the clear things I'm looking for is increase in positioning here, increase in positioning here, albeit like a negative Sigma, so it's not like crazy from a move perspective, which is good. Like it's just gradual increase. That means that it's not something where people were getting crowded. Like I'm looking at crowded positions in here. On the 10-day, it was slightly negative. On the 60-day, it's still down in terms of positioning, and it's only mildly up on the 30-day. Now, if I look at the positioning, then like this 1 day is essentially showing you what we see over here, right? You're getting this increase. That is what you want to see, especially like if you're trying to take the reversion trade. So you want to see negative sigmas across the board, mainly extremes, and then following on from that, you want to start seeing positioning turning around. So like on the 1 day, which is going to be the most sensitive, you want to start seeing this go positive, and you want to see the sigma start to turn green, because then it is showing you that it is becoming, there is like an accumulation. Alternatively, there is short covering, which either way is buying, right? Playing the other hand, so something that hasn't performed very well over the last period. So we took Roblox as a short. You look at IWM. IWM is an example, and this was before these moves like happened after we started looking at shorts for this. But if you look over here, like on the 30-day and the 10-day, it's only mildly negative. I mean, go back to last week and it was different, right? This was all green, IWM, when I look at it. And if I go to ARC in particular, which would be an even better precursor, I would see the same thing. So ARC was positive here on the 14th and here again on the 31st of March. Looking at those, I would have seen the same thing on the Sigma table. I wouldn't have had to look at anything beyond this just to like screen stuff out. So if I like filter for ARC, I can see the same thing here. And on the Sigma table, you get a similar kind of view, right? On the 60-day, it's up, which you're basically like seeing overall. And it's been trending up. But then when we took our short on Roblox as an example, where we saw a couple of other things to act as confluence, like Pluto and Jupiter alerts, signaling that it was like very overstretched. The complement to it was the Sigma table. I always look at the Sigma table first to kind of just like whittle down stuff. And also just like corroborate what I see on the market maker model in terms of like squeezes or bearish or shorts or long. Now, going into this move, I could see positioning's already like long overall in this sector. It's blown off. Historically, like over the period, every time this has happened, you've had reversion. Did it here again? You've had reversion. Did it here again? You had another reversion, right? So on the Sigma table, it was all positive, just across the board. And when I'm looking at that, I'm thinking, okay, that is an opportunity to be short, right? Does that make sense?
Yeah, thanks.
And then you like to corroborate ARC, because we have SARC as well, which is nice. You see the same stuff, but in reverse, right? So when you get deep negative positioning in SARC, it's like, okay, that complements it. I mean, given the fact that it is inverse, and I'm seeing just like negative across the board, it's way too negative. I don't want to be long ARC at this point. If anything, I feel like they've just pushed too hard on the positioning as identified by the sigmas, and as a result, I want to take the reversal. And it's not always going to work out. Sometimes it just takes a bit of time. Like we've seen a bunch of times, even if you look at this stuff visually, because that's what this is doing. This is taking all of that and basically just turning it into a number. So you don't need to look at all the charts, because there's a lot of noise. Like going through every single chart is a lot of work. Whereas this table just whittles all of those tickers down by sector and makes it a whole lot easier to review them all. Is how you want to look at it. And then you can just corroborate the same thing here again. Like if you're looking for overall like market strength as an example, line it up with returns and you can see the same sort of stuff. Like IWM as an example generally tends to have daily returns of around minus 2.92. However, usually within two days of that, IWM will have another negative return and then it will reverse back. If IWM, so like just looking at this anecdotally speaking, and see, I compute the stats on this, so like I'll run it across longer time frames. But if you were just eyeballing it, you can see, right, with IWM, every two periods, every two like major negative periods, there's another positive period. So I want to long the high beta names during that time. Every time I see that, especially if it's a deep negative, and just give that a go. Cool. All right. Okay, so for each ticker, you apply the same principle. All we're looking to do each time with every ticker is find points where the ticker is extended, like in terms of positioning. And what we're doing with Skew is I apply my own methods to determine where demand is on calls and puts. Using that methodology, I can identify when demand is overstretched to one side. So if puts are overstretched, there are going to be people who are already in them. And if they're already in them, they will more than likely take profit. Because by the time they're overstretched, too many people are in them. And when too many people are in any one trade, yeah, it can have momentum, but more often than not, it's about to start to reverse, right? So that's all we're looking for. So like on the Qs, you've got Skew over here, like here it's relatively flat, but this one point here on the 5th of May, you have a clear directional bias to puts. So this is basically telling you that puts are more expensive. Apply the same concept to individual tickers as an example. So I know Tesla is one to look at because it's rich in options. Options do move the stock given the amount that's traded in it volume wise. And you apply the same concept again. So Skew here, deep negative again. It did have a major pull down recently down to like 152. And besides like the negative positioning at 150, around the same point in time, you also had a lot of negative Skew going into it, right? And that made it an ideal candidate to go long. Same way with positive Skew. If I'm starting to see positive Skew across the board on big tech, but the indexes aren't showing it yet, then I don't really want to be long the indexes as much, because by that point, when you get the constituents starting to fall down, naturally algos which already do like reconstitution strats where they basically like create their own basket, they reconstitute the index themselves, and then they trade via those baskets. That is then going to have an impact on the index too, right? There's also algos that trade off correlation to the constituents. So if the constituents are going down, then I don't want to be long the index.
So it's like the vskew command, but it only has weekly expiration since there are no daily on tickers.
Yeah, because they don't have using each tenor. So like what this really is as well is a way of gauging fear and greed in the market, like for each ticker, but on a forward-looking basis. You can see right here, like is it overextended? Is there like a -50? Is there a +50? No, there's not. So, I mean, it's sort of like within moderation. It's not something that I'd be looking at thinking, okay, there's crazy reversion coming around the corner, right?
So it's the same metric as the index skew. It's the +50, -50 is what we're looking. Okay, great.
Yeah. So like Meta is a great example of that. Actually. We were long Meta 2 or 3 weeks ago before it started its squeeze. And the skew on Meta was like -1000. And you won't get the same numbers in any other like standard, because skew actually does have a textbook definition. That's why I call it Vex skew, because it's my own method. But that was like -1000 or something like that. And as a result, like I looked at it, I was like, okay, this doesn't make any sense to be short, really. Like when there's that many people short Meta, like all it takes is like any minor, or first it tells you one thing. You know when they say it's been priced in for, when you've got deep negative skew on a ticker on a forward-looking basis, whatever event is coming up, and it was basically around the same period for earnings, because this is like 2-3 weeks out when we started looking at it. If they have bad earnings, but the skew is deeply negative, those earnings need to be really bad to really create that downdrift. Now, if you're a betting man, you want to just take the flip side each time, and you might be wrong 2, 3, 4 times or whatever. But if you're right, and
the reward's going to be greater.
Yeah, your wins are just going to be greater. Like and it like goes back down to like the other principle as well of everyone aims for like super high win rate, but there are a fair few traders or quants who don't have high win rates, but their win rate being low is like completely compensated by the fact that their win like percentage on a notional basis or their profit factor way outweighs any losses they take. It's like you go back to like the Simmons example, which is like, I mean, his win rate is like 50 something percent, but he's arguably like, or not even arguably, easily one of the most, if not the most profitable quant fund in the world. And
unless there's someone we don't know about.
Yeah, unless it's someone we don't know about, but he's the one that's like popularized. And there are other people who do the same thing. Like I know people who have like 20% win rate, but the losses are so small because they'll cut them very quickly. I mean, like trading on ER is probably not a great idea because of the vol crush. But I mean, if you mitigate your risk from the directional side, selling vol in certain directions, within the right sigmas as well to like account for what's already being priced in on the implied vol or the expected move, then you can benefit from it, right? Cool. All right, so moving on to the next one, how you're combining the tools to find trade setups. Quick rundown of your full process would be really helpful. Right, so this one's pretty simple, and it, it is as simple as like what I put in the training sheet. So you have on futures like buy the dip levels, sell the fucking rip levels for deltas, for gamma, buy the dip and sell the fucking rip levels here as well. Same for Vanna and Charm, same for Skew. I just repeat this process over and over again. Now, if I'm like looking, I'll combine everything all together. So I'll look at the sigma table as we looked at earlier. Like I'll look at this to identify sector. I will go to the indices page and look at positioning overall as well. And then one of the other things I like to do is look at the market maker model. And I will pretty much just filter for long squeeze, short bearish, and see if anything hits. Now, if it doesn't hit, fine. I'll go and look for longs and shorts separately, and then I'll also look for just squeeze and bearish. So if you guys don't know if you can do this already, this is a pretty easy way to start filtering things. So you could type short and you could type bearish, and it will automatically filter everything for you. Now you can also add a date, 2204 and then 2, and it will automatically just filter for April 20th and above, right? So I've typed in short bearish, and I can see this over here. Now, SQQQ was on here, short, no squeeze. Looking at that, and I'm thinking, right, that happened on the 26th. On the 28th and the 27th, we basically ripped, right? That's like one thing I can look at. Another thing over here is like, okay, well, actually, you've also got vol being short, sort of like counteracts each other a bit. And I mean, most of the moves were fairly choppy. Like you had sell and then you had a rip. You'd sell and then you had a rip up. So there's that too. But this was short bearish on the 26th. So that kind of like added up. Actually, no, it wasn't contradictory. Sorry, it added confluence. Is what I meant to say. My bad. The other way, like I whittle this down and like try and find stuff to look for is, okay, so if I've got squeezes on here, and squeeze doesn't get filtered as well as it could because of this no squeeze bit, but I'll change that so you don't have to do the same thing. But type in a squeeze as an example, go filter in dates, those in between, stick those in. So let's go here. I'll typically look back like a couple days. Right now I've got my filters in. I've already got squeeze in there. Maybe I just want to type long at the same time. So I can see over here, like we were looking at renewable. It also happens to be a long squeeze on the MM model. Now I can go back to this now. I'll click that link. It will take me over. I can see visually the positioning as I hover over it. So that becomes like quite easy to tell, oh, okay, that looks like it's super overblown. I can see JD on here. I can see plug on here. I can see error on here. Go take a look at that. I mean, on the 26th was when that got listed. If I took a long right from the open, I had a decent-ish return straight off the bat. I mean, went from 163 or 164 roughly to around 173. So you've got about a $10 move there, right from the open, right? And that was just going right off the dot. Oh no, wait, sorry, it was on the 26th, so it wouldn't have been here. Would have done the same thing around here. So you could have started your trade around here, 164, and then you had another trade going up about $4. Ultimately, it did reverse after, but I'd be looking to take this for a longer trade, ideally. But given bad earnings, I'd just give it a bit of time, because usually you have like a Momo period where you get dead cat bounces and people who were in the name were too late to sell, so any pops get sold off. So I'd review the profile. Okay, like I've got deep negative strike over here at 150, still to be taken. I'd go and take a look at like longer dated. They're all gearing for this 150. I don't necessarily want to be long this yet. I'll wait. There's a very real possibility that it goes down first. And PDD, which was one that we mentioned, was another example of that. Like I wanted to be long, and I saw on Sigma table that there were those issues, but we also saw that there was 65 and 60 on, or 65 rather, popped up midweek, but 65 was there too. I was like, okay, well, I just need a bit of time to let it play out. I won't jump in straight away with the size that I would. I'll just wait for it to play out first, and then I'll go for it after. The other thing I'd look for is Pluto. So, I mean, if you guys didn't know already, Pluto is available like directly on the chart. So you can see it here. I mean, you had a 5.1 read or 5.22 read the day prior on the 25th. Heading into the 26th, like you had a bit of drawdown, like pre-market. market opens, I'd look at this and like, okay, well, volas are extremely positive, as you can see by the numbers and on the chart. And at the same time, Pluto is just way extended. So a bounce is due to come. And you get a reading of 5. It's well worth the try to trade and just at least get a pop. Earnings were bad, so I wouldn't be in it. You at least have that, right? Then you have Skew as well. So is that negative or positive, just like simple framework? And seasonality as well. Like, is that bullish or bearish? So framework is typically just, are the sigma tables pointing in the right direction for reversion or trend continuation? Yes or no? Is the MM model already agreeing or saying something that kind of matches what I'm seeing in the sigma table? Yes or no? Flip that into the options analytics page, review the strikes, see where that's gearing toward. And then I want to check Skew as well. And then finally, seasonality. Another thing to check, which is just more on the Discord side though, is can I also see bid, right? So I can look at this and I can see on the 26th it's just being absolutely hammered. It's not worth being long because it got completely wrecked during earnings and it's not standard amount of volume. It was like a ton. People were really like trying to get out during that period, right? So it did have a protracted move and it was matched by the amount of volume traded. But then I can see like, right, if I'm waiting for a reversion, I want to see positioning pop up or at least major volume pop up near the base of the candle as it's about to reverse. And you can see like tons around here, right? But then at the same again, like it's just continuous, like they're just trying to get sell at the top again. Now the candles also change a different color, and that's the hourly relative volume calculation that basically like tells me this is not standard volume for that time period. And the reason I do that is because volume is often looked at on a moving average basis for intraday periods, but that if you are trying to trade intraday, it makes zero sense to do that because the time periods alone are very different. Like we know power hour has more volume. We know that lunchtime has less volume. We know that the morning has more volume. If you've got a moving average, automatically the moving average is going to just not take into account those seasonal differences intraday. So that's another important thing. And then the same thing applies even when you like go out to longer time frames during weeks. You get different volumes during different parts of the week. You get different volumes during different parts of the year, months, so on. Like sell in May, go away, Christmas period, all of that jazz. Next question. And yeah, sorry. So we were talking about VX levels just then. Hopefully I've answered the roll vol bit, which is like relative volume. And then the H3, H1. Yeah. So H3 is always stronger than H1 because you're now getting to the extreme of what the market is suggesting the range is going to be for that ticker. Then that's why it's useful to determine trend days and just standard days, right? Because if you start moving out of those bounds, the market is quite clearly telling you from a price perspective, this stock is going to move in another direction or the direction it's being taken. Here. So if you take a look at this as an example, right? So EMPH, like this is like a live example. You have clearly got like negative positioning over here. Like you can see that from like the gamma already. And this will updates simply because of the fact that as time goes on, data continues to draw down. And this does continue to refresh like you just saw it just now. Now, this net negative Vanna profile be supportive when you've just got puts over here if you start to get a decrease in vol, right? Now, you can combine the expected vol model, which is what the expected move is based on the current landscape of implied vol. And quite clearly here, you can see there's a decline in vol, which would make sense given the fact that it's just had earnings. As a result, then, when you've got puts down here and they've got negative Vanna, but they're decreasing at the same time, you then get a continued push further down. So that's acting against the common view, which would be here's your negative gamma, they need to rehedge once it goes in the money and so on. However, if you end up with positive Vanna, you end up in a different situation. If there's positive Vanna, right, and you have an increase in implied vol, then you're going to get a squeeze in that direction because that's telling you Vanna, it's telling you there's a positive relationship between Vega and Delta, and as a result, you're going to get an increase in value in those options. As those options start to increase in value via the implied vol, that then results in a situation of market makers are essentially viewing that option as having a higher likelihood of going in the money because all implied vol is just a range. It's saying this is the range or the expected move based on these particular strikes. And as a result, you then get the increase. So it's literally just, if you're going to boil it down to a simple back of the envelope, trying to not get into crazy complexity around the calculations and so on, negative is a plus, positive is a plus, negative minus is a plus. So negative minus being negative Vanna, an increase in vol would drain these, and then as a result, you get reversions and so on. Hope that makes sense. And another way to look at that is your net Vanna over here, where you've got deep negative net Vanna. Well, not deep negative, but you have a net negative Vanna amount over here. So is this positive? Is it negative? Overall, what's the profile looking like? Hopefully that makes sense.
Right, so with this end phase example, we have the net negative Vanna, and you can see the vol is starting to roll off because we just passed ER, so that would then impose more of a downdrift.
Yeah. But the interesting part is this bit over here, right? So focus is here, that's going to pull towards this. You've also got peak negative gamma over here. However, you've also got a bunch of net negative profiles too, right? They start increasing in value, but they're already in the money. They're way in the money, right? And they're all set for May. So with that in mind, you would look at this and just think, and this isn't a great example because it's not as liquid. So but with that in mind, you'd be looking at it and thinking, okay, these are going to increase in value. As they increase in value and people start to roll those off, which you can visualize via the deltas, then it makes complete sense that then at that exact point, you start getting reversions just because of option mechanics. So Tesla's a really good example for looking at it on an options basis because as you can already see, the Vanna's much greater. So looking at this, you see similar things going on, right? When you look at this over here, this has got positive Vanna strike. As implied vol starts to increase, it will drive it towards this level. As it decreases, start to drive it towards this level as well. However, overall here, you've just got an increase in vol, positive Vanna, positive Vanna, positive Vanna. So if you get increased vol in this section, you're going to get a move up. Positive, positive. Negative, negative would mean a plus, and so on. And all you're really looking for is like the deltas to increase in these areas. Hope that, does that add up?
Yeah, that all sounds good.
So just look for positive, positive, negative, negative for pluses, increases in deltas, and then positive, negative, negative, positive. So like negative Varna, increase in vol, or positive Varna, decrease in vol. And it would make sense because if you think about it like this is way out of the money, right? The pull associated with this would start to decline if vol is decreasing, right? Your out of the money strikes become less likely to hit the like get in the money, and then as a result, these options lose value. So there's like a double-edged sword where people are like, I don't want to buy an option when vol is high. But at the same time, as we've seen with SPX, when you trade zero date, trading SPX now is horrible compared to when VIX was at like 25 to 30. It really is. Like, it's horrible. Yeah, you get vol crush, but if your timing is correct, you get much larger moves, and then as a result, the value of them go much further as well. Like the same concept applies, and like Jem Carson talks about the same thing. People want to buy vol when vol is low, but that doesn't make sense when you apply actual option mechanics to it. You want to buy vol when vol is starting to increase or getting higher, because then it has momentum. And a lot of that is down to this effect. Yeah, so the intraday expected moves, like you can literally just use the expected move amounts listed up top. So like this is your daily implied vol. It's basically like saying really should be daily expected move. The other part is over here as well. So you have your numbers here. When I hover here, the option market is telling me what it expects the move to be. So it expects over the month Tesla to move around 22%. Usually you have an additional risk premium baked into every option. And as a result, you can like take a couple percent off that. A way to figure that out is like, okay, well, this is saying on a monthly basis, this is going to move, or on a weekly basis, it's going to move 11%, right? So it's saying 10% here. I can see what the expected move is going to, like what the realized move has been in Tesla overall. Like if I hover over here, I can see the probability of higher from 10% from the stock being up 10% close to close weekly basis, and this is not taking any factors into account. It's literally week to week, give me the distribution of returns. So it's fairly simple. You can get nerdy with it and apply various factors like interest rates were this, and this is what seasonality was like in the stock, or liquidity was this overall in futures, and this is what happened in the stock, like conditional factors. And then you start getting into Bayesian conditional, or even more simple, if you just go down like the price route, what were the returns in a stock when the stock had a 10% drawdown 2 days ago over the next week? Stuff like that, right? Then this distribution completely changes. But overall, taking the law of large numbers, you can assume that this will be relatively correct. But then looking at this and like just applying it to this over here, I can say like just really simply, okay, weekly is saying around 10%, 10.5%. What actually happened during that period? And just to note, that's saying like either way, right? So 10%, 10%. I can see like on this like general basis, like it typically tends to stay within around like 9-ish% on either side, right? I mean, it's got more of a fat right tail, so more positive. But generally speaking, Tesla goes up more than it goes down during the week. First, because this tail is fatter. Second, if the stock is expected to make that move in the options cycle, like how much of that is generally around here? So if I look here, let's go with like 5%, 5%, 5% here, it's got about a 27% chance going higher during the week. And if I'm around 5% here, it's got about a 21% chance going lower during the week. So it's not that bad of an implied vol pricing mechanism in the options market. Fairly accurate, right? So that's one way to like get a gauge of that. The second thing is obviously like also just looking at where is positioning. That's if you want to get like very detailed with it. But I mean, if you're looking at multiple tickers, do you have the time to do that? Do you not? Can I automate it and make it systematic? Yes, I can. Is that going to come to the site? Yes, it will. But if you want to look at stuff like this, it's like, okay, well, 150 is a clear strike here. It's already made an attempt at trying to get there already. I can see phantom prints here showing the same thing. The lowest it had was like 153. It tried again, 153, failed. When is that option going to expire? I mean, the majority of that is set for May. After that, doesn't really seem like there is much if I look at short dated, but compare over here. Majority of it is all in May. So do I want to be short Tesla after May? Just looking at this time point where change, and gamma does increase the shorter, or the less time left to expiry. But looking at that, I'd be sitting there thinking, 150 is probably like where I want to start getting long, not short. And you can also see it over here. Like if it doesn't get to 150, there's a ton charm set to expire. You've got around 216 mil expiring just associated with this strike. But then also at the same time, you've got a ton expiring over here on the call side, 200, which contributes to its decline. But once you start getting the distribution around this area, you get supportive flows from charm. All right, this is just typically just has like a reversion signal to it. Now, as high yield has approached its low at around like the 65-ish mark to like 75 mark, where it's been in this range for a little while, that correlation has like died down a lot. And that is simply out of the fact that the correlations to the bond market have started to change like dramatically. People are trading or still trying to trade off the bond correlation, i.e. like treasuries going up in terms of yield is negative and treasury yields going down is a positive and so on. But high yield is also like kind of showing you already like that correlation is starting to change. It's not the same as it was prior. But what high yield is a good marker of is, generally speaking, if there is risk appetite. In general, though, like the way to use this, and I just caveated it ahead of like even explaining it, is you get an extreme on the positive side in terms of like the percentage move. That typically is then when you'd get a reversion. However, now that correlations have changed, so like let's say it's over here as an example, a high over here would result in a bid in SPY. as it goes down, which you start to see, right? Like moves down over here, you got a bid. High yield starts moving up. Again, you get a decline. As it continues to move down, you get an increase in SPY again. But as you can see over here, as we've started to meander out, but the signals aren't as clear as they used to be compared to prior periods.